What a week. I am so excited for this week's Macro War Room. So, without further ado, we're going to jump right into it because we have a ton of data to go over. And as always, we're going to start off with the liquidity and regime tracker. Let me move my camera here so this makes some more sense. I've made some updates to this. I've built my own global liquidity tracker, which is the green line here. So you can see we are very far off from current prices. We are actually 23% off from current prices. The last time that I could find recently where we've been this decoupled was back in September of 2024. And then we experienced a sharp correction higher, almost 100%. So if you want to take a look at it from this low to the high of Bitcoin, we did 96% after that. This is going to be super interesting. We'll see if this correlation with global M2 actually breaks, or are we going to have a violent snapback, a violent reversal? It's going to be an interesting one for sure. We are now sort of decoupled, at least temporarily, from global M2, which has been everyone's favorite chart all year because the correlation has been so tight. For the regime tracker here on the bottom, we are still, you can see I kind of mapped out these zones where we've been, and we are still sort of in this upper bound between 63 and 77. It's nothing serious. This is a very long-term indicator. It just kind of gives me a gauge of where we are in the cycle. Once this starts hitting near the top line at 100, this is indexed to 100, that's when you need to start taking chips off the table. We're nowhere near that yet. And, my prediction still stands. Q1, Q2 of next year of 2026 is most likely where we'll see the cycle peak. So let's get into the actual data that dropped this week because there was a lot. So what happened this week? Well, let's go sort of row by row. We're going to start off with the Richmond Manufacturing Index. This index measures manufacturing activity in the mid-Atlantic region. It dropped severely, minus 20. It's a straight up nosedive. It signals recessionary vibes, weakness in demand, falling business confidence. Weak manufacturing basically means more pressure on the Fed to pivot dovish. So this is actually a good print for Bitcoin. This could indicate a liquidity boost faster than normal. We'll go into existing home sales. This doesn't really mean much to me. This tracks the annualized number of existing homes sold. Housing is a major liquidity sponge. If it's slowing, the economy is feeling the rate pinch. Rates are still, in my opinion, too high. And falling sales signal tighter credit and waning consumer confidence, which boosts the odds of easing. We'll see what actually happens in terms of home prices, but this is probably the most lagging indicator. Housing prices move last. For the unemployment claims, it came in at 217K versus 227 expected. So slightly better than forecast. Low claims equals labor market is still resilient, which equals the Fed stays cautious on rates. This is their sort of one last thread that they're hanging on to. But in my opinion, this print alone isn't enough to change the broader trend of softening data. No real liquidity shift unless, claims start spiking. The most important things this week, the flash manufacturing PMI and the flash services PMI, which kind of was a mixed bag, right? Flash manufacturing underperformed. We got a 49.5 print below 50, which is technically contraction. It's a sharp miss of the forecast, meaning manufacturing shrank. Expect Fed doves to start chirping louder. Falling PMI means slowing growth and rising rate cut odds. So that's bullish for Bitcoin. For flash services, which makes up the largest sector of the US economy, it printed hot. That means the economy isn't falling apart yet, right? So we have two sort of signals at both ends of the spectrum. This print would give the Fed cover to delay cuts, which is a short-term headwind for liquidity. It's kind of a no man's land with these two prints. New home sales is whatever. I don't really care about that. The more important things to me were core durable goods and durable goods. So core durable goods excludes aircraft and defense. It basically tracks business investment in equipment. So it's not falling off a cliff. It kind of came in line. Steady CapEx means business aren't panicking yet. And it's not enough to really shift the Fed's thinking in one way or another. So it's kind of neutral. Durable goods, which includes big ticket items like planes and cars, absolutely, sort of came under forecast, but it was a straight up negative print. Falling orders means demand destruction and kind of disinflation. So in my eyes, this is bullish because the Fed will have no choice really but to inject liquidity. And obviously Bitcoin will front run the liquidity wave. So this week's data was kind of a strange one, but to me, it screams stagflation pressure. Like manufacturing is slightly buckling, housing is kind of cooling, and durable goods kind of got nuked, although in line with expectations. Services and labor are basically the last two dominoes. The most important takeaway here is that the Fed's narrative, it's cracking, and Bitcoin is basically sharpening its horns for the next liquidity pivot. Again, if we look at this chart, we have majorly decoupled from global liquidity. So if we do see a violent snapback higher, don't be surprised. Now, the question is, if we don't, what does that mean, right? What is now driving Bitcoin price? If it's not global liquidity, what are the other factors? And we'll be trying to figure that out over the coming weeks. So without further ado, let's take a look at the rate cut odds. And these have not changed. It's basically a shoe-in that at the end of this month, so next week, the Fed will not cut rates. That's been the trend. Nothing's really changed here. What was interesting to me was that September, the odds for a rate cut slightly increased. So I think last time this was 59% or 60 or something. So it went up another 3 or 4%. Whatever, not much has changed there. This moves really slowly. Again, for October, it's 50% that they don't cut a second time and 30% that they do have a second cut. So we'll see how this kind of moves. Let's take a look at my spreadsheet, my system, and what has changed here. And TLDR, nothing. Absolutely zero has changed here. Extremely bullish still. Risk on. Don't let these, X, Twitter, whatever, was having a meltdown this morning over us dropping to 115K. Did you think this was up only? It's not up only. You're going to expect violent volatility on both ends. Use those dips if your system is telling you you should still be bullish to add if you can, or average down if you bought higher. So it was just funny seeing my timeline, people completely melting down over going back down to 115, 114. This is Bitcoin, baby. This is what it does. If you're not ready for the volatility, you are not ready for the massive upside and massive gains. This isn't bonds. This isn't stocks. You need to have conviction. You need to, on days like this, and especially I remember when we had the yen carry trade, that was my one realization. And I still have this sticky note on my monitor. Remember your thesis. When price is down, especially when price is down big, remember your thesis. What is your overall thesis for the long term? Has that changed? If not, buy when there's blood in the streets, right? And it's easier said than done. I was sitting there that night when the yen carry trade unwind was happening, and I was thinking, damn, do I really want to put more money in? What if this is it? What if it's over? And look where we are now, right? We are back. We are up at all-time highs, 120K, and the cycle continues its run. So you got to have your conviction, you got to have your thesis, and you have to remind yourself of the long term. I always kind of play a mind game with myself. Like if I cryogenically froze myself today, right? So it's July 25th, and I woke up in December, what would I want my portfolio to look like? And what do I think we'll be at? And that's how I kind of frame things. So anyway, I didn't mean to go on a rant there, but the trading psychology is super important, especially in Bitcoin where it's so volatile. Let's take a look at the actual on-chain inputs here that are at the bottom. At CryptoQuant, again, IFP is still bearish, which is insane because it's been bearish since 96K and we've already run up to 120K. I harp on this every time that it's crazy to me that it's still bearish, but it is what it is. It's the only bearish indicator in my system currently showing up for the Bitcoin bull bar. The bull bar market cycle indicator, still bullish, although not heavy, just kind of barely above into the bullish zone. Same thing, nothing's changed. MVRV score, still bullish, nothing's changed here. I did want to point out that the Sharpe ratio has sort of cooled off a bit, which is good. And there was one other thing I wanted to mention, which is long-term holder net position change. So we had this insane spike. This has now come off, and retail actually started buying probably within the last week and just got nuked. And this is exactly what you need. Retail comes in, they do a sweep, they nuke it, and then they run it back up, right? Retail panic sells, institutions buy your bags at a slightly cheaper price, and the bull run keeps going. Whether or not that actually plays out, we'll see. Another interesting one was long-term holder, short-term holder. SOPR has completely reset, which is very healthy in my opinion as well. You can see retail investor demand spiked, and now we got a nuke. And so onwards and upwards, in my opinion. The only other thing I wanted to mention here that I thought was positive was, we already talked about the Sharpe ratio, but this is the short-term one, and it has almost completely reset to zero, right? It's at 1, and it's not far away from actually hitting sort of the green zone. So to me, that could give us fuel for the next leg. Trump talking about Powell's renovations. Definitely check this out.
So we're taking a look, and it looks like it's about 3.1 billion. It went up a little bit or a lot. So the two.
Look at his face. He's just like, no, it hasn't. No, it hasn't. They're wearing these stupid construction helmets. This is absolute peak political slop. I love it. Let's play the clip a little bit longer. Hold on.
0.7 is now 3.1.
Not aware of that.
Yeah, it just came out.
Yeah, I haven't heard that from anybody at the Fed.
It just came out.
Our notes said it about 3.1 as well. 3.2. This came from us?
Yes. I don't know who does that.
You're including the Martin renovation.
So the absolute state of things right now, where you have the sitting president calling out the chairman of the Federal Reserve around spending and saying rates are too high. I mean, it's peak, like, just craziness. So anyway, hope you enjoyed that. If you haven't seen that, definitely check out some of the comments on that because it's absolutely ridiculous. So that's where we are. That's it for this week. I hope you enjoyed this. I do this once a week on Fridays. If you want any of these indicators, they are available free on my TradingView profile. So definitely check them out. The Global Liquidity one and the Bitcoin Liquidity and Regime Tracker down here are both available free. Again, I drop these every Friday. If you are watching this out there, thank you so much for sticking with me and hanging out. I really appreciate your viewership. If you enjoy this kind of analysis, and it wouldn't be a big bother for you to hit the subscribe, it would really help my tiny channel. So that's it for this week. See you next week. Have a good one out there. And as always, thanks for watching.